Dear students and scholars, we are continuing ASC 350 with identifiable intangible assets other than goodwill. In the last video, goodwill had the spotlight. Today we move to patents, brands, rights, customer lists, licenses, and similar assets. The accounting answer here depends on five things: how the asset was recognized, how it was initially measured, whether the useful life is finite or indefinite, whether amortization applies, and how impairment is tested. So, this is not just an asset naming lesson, it is a full accounting treatment lesson. Our learning path begins with classification, not with the journal entry. That is very important. First, we identify whether ASC 350 subtopic 30 applies. Then we ask how the asset entered the entity: separate purchase, asset acquisition, business combination, or internal creation. After that, we measure the asset, assess useful life, apply amortization if the asset is finite lived, test for impairment when required, and document the conclusion with proper controls. The memory hook is simple: classification comes before calculation. ASC 350 subtopic 30 is the main home for identifiable intangible assets other than goodwill. It covers separately acquired intangibles, group asset acquisitions, post acquisition intangibles, and internally developed identifiable intangibles when recognition criteria are met. But it does not cover everything. Goodwill is handled separately under ASC 350 subtopic 20. Capitalized software generally follows ASC 350 subtopic 40 or ASC 985 if it is software to be sold. Some insurance contract intangibles are also scoped out. So the first control checkpoint is scope. Are we even in the right subtopic? There are two major asset families: finite lived and indefinite lived intangibles. A finite lived intangible provides benefit over a determinable period, so it is amortized over that useful life and reviewed for impairment when indicators arise. Examples include patents, customer relationships, and non compete agreements. An indefinite lived intangible has no foreseeable limit on the period of benefit. It is not amortized, but it is tested annually for impairment and sooner if a triggering event arises. Remember this carefully. Indefinite does not mean infinite. It means the benefit period cannot be reasonably limited today. Before recording an intangible asset, identify how it entered the company. A separate purchase is recognized as an asset at cost because the purchase price gives reliable evidence. In an asset acquisition, total cost is allocated across the acquired assets using relative fair values and no goodwill arises. In a business combination, identifiable intangible assets are recognized at acquisition date fair value and any residual may become goodwill. For internal creation, costs are usually expensed as incurred. Capitalization is the exception, not the default. Initial measurement requires fair value discipline. In a business combination, each identifiable intangible asset is measured at fair value on the acquisition date under ASC 805. In a separate purchase, the purchase price and directly attributable costs usually provide the measurement anchor. In an asset acquisition, total cost is allocated using relative fair values. The critical distinction is this: goodwill is recognized only in a business combination. If someone tries to create a vague residual asset in an asset acquisition and call it goodwill, that is not careful accounting. That is accounting with a magic marker. For internally generated intangible value, US GAAP is conservative. Most internal costs to develop, maintain, or restore intangible value are expensed as incurred. Internal brand building is expensed. Customer loyalty efforts are generally expensed. Training and reputation are not separable assets. Internally created goodwill is never recognized as an asset. This creates a known comparability issue. Two companies may have similar brands, but the company that acquired the brand may show an asset, while the company that built it internally may not. The exceptions, like software and website costs, have special guidance and will be covered in the next video. Defensive intangibles are a useful real world idea. Sometimes a company buys an intangible asset not because it wants to actively use it, but because it wants to prevent competitors from using it. That non use strategy does not mean there is no asset. If the right is separable and has value, it is recognized as an identifiable intangible asset and measured at fair value. In practice, many defensive intangibles are finite lived because the defensive benefit usually lasts for a determinable period. The asset is then amortized over the period in which that defensive benefit is consumed. Useful life judgment must be supported by evidence. Management cannot simply say, "We feel this asset will last a long time," and stop there. The analysis considers expected use, contract or legal term, renewal history, obsolescence risk, competition, and maintenance cost. A patent may have a legal expiration date. A trademark may be renewable if the company intends and is able to renew it. Technology may become obsolete quickly. Competition may erode value before the legal life ends. The central question is, what period of benefit can management support with evidence? Once an intangible asset is classified as finite lived, the amortization model begins. First, determine the useful life. Second, estimate residual value, which is usually zero unless there is strong evidence otherwise. Third, choose the amortization method. Straight line is common, but the method should reflect the pattern of benefit if another pattern is more appropriate. Fourth, record amortization expense each period. Fifth, review impairment indicators. The financial statement effect is clear. The balance sheet asset decreases over time, and the income statement records amortization expense systematically. Residual value for an amortizable intangible asset is usually assumed to be zero. A non zero residual value needs positive evidence. That evidence could be a third party purchase commitment, an active market expected to exist at the end of the useful life, or reliable market based residual value support. Management cannot simply invent a residual value to reduce amortization expense. That may look attractive for earnings, but it is not acceptable support. In exam terms and in audit terms, a residual value assumption needs evidence, not optimism. Let us calculate a simple amortization example. A customer relationship is acquired in 2027 for $6 million. dollars. It has a useful life of 5 years, a residual value of 0, and straight line amortization. Annual amortization is $6 million dollars divided by 5 years, which equals $1.2 million dollars per year. The yearly entry is debit amortization expense $1.2 million dollars and credit accumulated amortization customer relationship $1.2 million dollars. After year 1, the carrying amount is $4.8 million, dollars, then 3.6 million, 2.4 million, 1.2 million, and finally 0 after year 5. Finite lived intangible assets connect to the long lived asset impairment model in ASC 360. Unlike goodwill or indefinite lived intangibles, finite lived intangibles are not automatically tested every year. Instead, impairment analysis begins when an indicator appears, such as technological change, legal damage, poor performance, or other adverse events. First, the recoverability test compares carrying amount with undiscounted cash flows. If those cash flows are below carrying amount, the asset is not recoverable. Then impairment is measured by comparing carrying amount with fair value. So the sequence is indicator, recoverability, fair value measurement, and loss entry. Now look at the patent impairment entry. The patent has a carrying amount of $3 million. dollars. Recoverable cash flows are below carrying amount, so the recoverability test has failed. Fair value is $2.2 million. dollars. Therefore, the impairment loss is $800,000, calculated as 3 million minus 2.2 million. The journal entry is debit impairment loss $800,000 and credit patent intangible asset $800,000. The income statement records the loss and the balance sheet reduces the patent directly to $2.2 million. dollars. Under US GAAP, that impairment loss is not reversed later. For indefinite lived intangible assets, the model changes. If the asset has no foreseeable limit on its useful life, no routine amortization is recorded, while that conclusion remains valid. Instead, the asset is tested for impairment annually and also sooner if triggering events occur. If circumstances change and management can now estimate a finite life, the asset begins amortization prospectively from that point forward. Common examples may include renewable trademarks, certain broadcast type licenses, and established trade names. But again, indefinite lived does not mean immortal. Even strong brands can be impaired. Before doing the full quantitative impairment test for an indefinite lived intangible asset, management may elect a qualitative screen. The question is whether it is more likely than not, meaning greater than 50% likelihood, that the asset is impaired. Inputs may include cost increases, declining financial performance, adverse legal or regulatory changes, market decline, technology changes, and entity specific events such as restructuring. If the evidence does not indicate likely impairment, the company can document that conclusion and avoid the quantitative test. If the evidence points toward impairment, the quantitative test is required. The quantitative test for an indefinite lived intangible asset is a direct fair value comparison. There is no separate recoverability step like the ASC 360 model for finite lived assets. In the trademark example, carrying amount is $9 million dollars and fair value is $7.5 million. dollars. The impairment loss is $1.5 million. dollars. The journal entry is debit impairment loss $1.5 million dollars and credit trademark intangible asset $1.5 million. dollars. After impairment, the new carrying amount becomes the new cost basis and reversal is prohibited under US GAAP. Unit of accounting matters for indefinite lived intangible impairment testing. The default is separate testing, but ASC 350 subtopic 30 permits combining multiple indefinite lived intangible assets only in limited circumstances. Combination may be appropriate when assets are used together, create higher value as a group, follow a unified brand strategy, and generate cash flows that cannot reasonably be separated. But do not combine goodwill with these assets because goodwill follows ASC 350 subtopic 20. Do not combine finite lived intangibles either because they follow ASC 360 impairment logic. The testing unit must reflect how value is actually generated. Close controls are not paperwork decoration. They are how accounting conclusions become defensible. Legal confirms rights, renewal terms, and contract limitations. Business operations confirm expected use and whether the asset still supports operations. Finance and FP&A support forecasts, cash flows, and impairment indicators. Senior management supports strategy and useful life assumptions. Accounting then reviews useful life, residual value, impairment indicators, carrying amounts, amortization methods, and disclosures each reporting period. A conclusion without evidence is just a memory exercise, and auditors do not audit memories. That completes our lesson on finite and indefinite lived intangibles under ASC 350, subtopic 30. We learn to identify the asset source, separate finite life from indefinite life, amortize finite lived assets, test finite lived assets for impairment when indicators arise, test indefinite lived assets annually or when triggered, and document professional judgment with evidence. In the next video, we move to internal use software, cloud arrangements, and website development costs under ASC 350, subtopics 40 and 50. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues who are building strong US GAAP skills.